Welcome to session 10 of Pi Fellows program. Today we are going to learn about how to structure a deal. And in this session, we've actually created a couple of case studies, and we'll have live discussions between four teams, two VCs and two entrepreneurs. And to facilitate and provide direction in all this process, we have Pratik Poddar from Nexus. Uh, Pratik is an upcoming VC. He's been in the VC industry for the last 5 years. IIT Bombay graduate, 2010. Uh, my association with Pratik is around 3-4 years old. I think we've been in touch in different forums. So very happy to welcome you, Pratik. All yours.
Thank you, Manish. My pleasure. I'll just introduce myself for the team. As Manish mentioned, I graduated from IIT Bombay, worked at Morgan Stanley Quant Group for some time. I was more of a techie then, did not want to come on the business side. Wanted to do a PhD, but somehow did not want to go outside India, so ended up joining Morgan Stanley Quant Group. Then I worked for Blackstone Private Equity, and the intent to join Blackstone was to learn how to build businesses because I wanted to do a startup after that. Unlike most people who go for an MBA. I quit Blackstone and worked on my startups for 3 years. Nothing worked out. And we say this often, startup और कुछ सिखाए ना सिखाए philosophy सिखा देता है. So after 3 years of failed experiences, and during that time I had met a lot of VCs, so developed liking for the job at some level. So joined Nexus about 5 years back. At Nexus, we're a smallish team. The fund size is reasonably large. We manage about $1.5 billion of assets. The last fund was $450 million in size. But the team is small. We have 3 offices: one in Mumbai, one in Bangalore, and one in Silicon Valley. We are based out of Bangalore. I'm based out of Bangalore. The firm is about 14 years old. We started as an India-US cross-border fund, where we invest in companies that are starting from India, moving to US, or people from US coming back to India and starting companies. And over time, as India market also grew, we started investing in India consumption market as well. And that is about 50% of our portfolio. So Nexus, we have typically seed series investors. So we would typically come after Manish has invested, or when no investment is there, we will typically be the first or the second institutional investor in any company that put in $2 to $5 million as the first check typically. So that's a brief background of the firm, of myself. I saw some of the videos of the last sessions. This is structured slightly differently. We thought this is not a slide based or a lecture based session. It is more workshop, so it should be different. Hopefully it should be interesting. Guys have done and brainstorm and debate. So, one interesting aspect of this discussion is there's no right answer. There's no wrong answer. It's more about what is the argument you are giving for every point you're making. So everything that you say is wrong, and everything that you say is right. It's just about the positioning and the story behind that argument. So that way it should be a fun discussion, and look forward to active participation. Yeah, जो मैंने videos देखे थे उसकी तरह it's difficult to just sit tight here.
Yeah,
it has to be more participative for sure.
Great. So what we'll do is I'll slightly try to play the moderator role here, especially in the construct of the negotiation, right? So can we have the first teams, Power Law Ventures and Go Home Go Big teams show up? Maybe you can switch on your videos, etc. And what we will do is just like we discussed, right? Around 5 minutes, you can one of you, whosoever is a lead speaker from the team, the VC team, which is the Power Law Ventures, can actually present your term sheet to the Go Home Go Big team, and then the Go Home Go Big team will come up for 5 minutes, explain their term sheet back to you, and then we will have 5 to 7 minutes of asking questions, right? The VCs and the entrepreneur can sort of negotiate and ask questions in different terms. And then we will have Pratik come in and sort of give you another perspective on how this could be done differently, or what are the boundary conditions, etc. Right? So we'll try, the goal is we will try and wrap this up in 35 to 40 minutes, the first case study, and then another 35 to 40 minutes, the second case study. Okay. So pardon me if I have to play a little strong on the timing bit. So with that, let me get the Power Law Ventures. Who's the lead speaker for Power Law Ventures?
So
Manish, Arun will take this up.
Okay, Arun. Arun, do you want to share your screen and go from there?
Sure. Just give me a second.
Yeah, the other teams who are going to present, please get your file ready.
Okay, so you guys can see my screen, hopefully.
Yeah.
Cool. So we're Power Law Ventures and happy to present a term sheet to go home or go big. So guys, the pre-money valuation we came up with was 3 mil, and for an investment amount of 1 mil, which is what was being requested. Should I also give you comments on why we chose these things, or just present the term sheet?
Yeah, good to present the details on why you did what.
Cool.
So that would be interesting for the group to discuss as well.
Yeah.
Try to wrap it up within 5 minutes, Arun.
Yeah.
Sure. So the idea here was the reason why we chose this valuation because we don't have enough details about the company per se in the information that is given to us in the assignment. But we definitely know that we want to achieve a target ownership of 25% post money. Hence, the deal has been structured this way. Plus, we of course know what they want. So we have kind of worked backwards and come up with this figure. Now, in terms of the investment instrument, this is straightforward preference with liquidation of 1x and non-participating. Now, why that? Because this is what is fair as of now, generally perceived. I understand this has been a bit of a moving target in the past. While in the past, maybe 2x would have been more, even now some people would do it based on perceived risk and all of that. That's something that we did think through with regards to this deal as well, because it was mentioned that MVP itself has not been achieved. MVP is not out yet, and we are still probably a couple of quarters away from having enough validation on the business. But still, we thought we'll keep it fair because there is competition in the deal, and you want to be perceived as a VC that's giving out a fair deal. Plus, I think later investors would also perceive this negatively if you're going to be taking 2x of what you put in at the time of liquidation. So the others will have less to take out. Non-participating too, because participating in general is also perceived very negatively because you're going over and above, taking out your money and then participating in the proceeds and the rest as well. So that's the rationale here. ESOP, we stuck to 10%. From what we understand, about 10 to 15% could be standard. 15% is considered quite okay as well. 10% because this business also already has 3 founders. So in that sense, I think a lot of the leadership piece, I'm guessing they've kind of figured it out. They've stuck together for 2 years. So it's 3 founders over 2 years. Sounds like they've got a decent leadership team that's been working together for a while. So 10% may be enough for them to go ahead and do the hires that they need post this. We've also done our research and kind of figured out that founders perceive a very high ask from the investors' side to carve out a really large ESOP pool post the funding round, as also to that's not perceived very positively as well. It's something that they would like to take a call as and when it happens. Of course, if we were to say stick to 15-20% here, then that means they would probably not have to expand it later on. That's planning for the future. So we were tempted to go with a higher amount, but I thought 10% is good enough in this case. A board of director, one director, one observer, that's standard. And we're assuming that there's one director from the founder side. For this stage, I think a small board is ideal. In terms of vesting, 25% on closing date. Why? Because again, these are 3 founders who have already put in 2 years here. So you want them to own 25% right from the get-go. The rest vests in 4 years with a year's cliff, quarterly vesting, which is fairly standard. Now, what are the permitted transfers? Now, the founders are able to transfer the shares. You're not put a lock-in period here per se, but all transfers are subject to approval of the investor, of course. Right of first refusal to the investors, first and then to the promoters, to the other promoters, one founder is leaving. Then, of course, this is subject to the tag-along rights. Now, what does that look like? Okay, the next point, of course, is the preemptive rights. So we want us to be able to always maintain ownership on a pro rata basis. We did not choose super pro rata because that again can be a little problematic to subsequent investors that we would want to expand our pie later on. So that's something that we stayed away from. Now, in terms of the drag along, so drag along can be enforced only 6 years. So there's a lock into when these guys, when we are able to have this drag along. And 50% of people who own the preferred stock are supposed to approve the drag along. Now, why is this in place? Is because drag along again is sort of a worst case scenario. If the company is not working out and we give them enough time as a founder. Now, on the founder side, also you want to work with a VC that's giving you at least 5 to 6 years to really try everything that you have before you can drag them along into a transaction or a sale or something, which is not what they perceive as the ideal outcome. So in this scenario, we want to give them enough time, which is why 6 years. And we also want to make sure that, let's assume in that scenario, for us, it's a fire sale. And it's just us, or if there's been some more validation, maybe there's another investor. It should be enough for about 50% of the preferred stakeholders to just take a call that it's time to sell, and we should be able to make it happen. A more founder-friendly version would have been maybe about 75%, but we decided, I think, given the risk in the deal, this is fair. Now the tag along, right? Of course, investors full tag along. In a scenario where there's greater than 1% transfer of founder stock. We were also tempted to word it in terms of common stock, greater than 1% of common stock. But I think this is the term that we stuck with for the time being. Anti-dilution is going to be broad-based. Everything else is narrow-based is sort of okay, but broad-based is the fairest. Full ratchet would be pretty unfair. So yeah, we want to have a founder-friendly deal. So this is what we come with. That's it. Then the cap table that emerges out of this is fairly straightforward. These guys, we get to own 1 million out of 4 million post money. So that's 25% and 10% to ESOP and the rest to the founders.
Okay, thanks, Arun. Can we get the Go Home, Go Big team? You can stop sharing, Arun. Thank you.
Can everyone see the screen?
Yes.
Yeah.
Okay. So I think congratulations, PLV. I think we are very close to almost. We are very aligned on the term. I think.
Aniket, if possible, switch on your video. That would be good.
Where am I?
Just stop sharing, then you will see the option easily.
Got it.
Thank you.
So thank you for the term sheet, PLV. I think we are quite aligned on the valuation. We also agree that our pre-money valuation should be 3 million, given that we've worked for 2 years, have an MVP. Founders are, tightly knit founders with complementary skills. Investment amount, as discussed, is 1 million USD. We should get to our product market fit and show some kind of traction. Investment instrument, as agreed, should be preference shares with a 1x liquidation preference, no participation. That gives you and us, the best outcomes at all times, even if we go on and raise a series round. ESOPs, as is the normal standard, we are okay with 10% post money because that helps us to have incentives designed for our employees. On the key considerations, I think since we have almost 3 founders, we would be open to giving 1 board seat. That gives a fair representation to the seed investor. Also allows for room for series investors to come in later. And since we've already been working for 2 years, there's been a lot of sweat to this company. We are proposing a vesting of 3 years, a monthly vesting with no cliff. So that keeps us aligned, and we, with the timeline that we're hoping, this company should be in a good shape over the next coming years, and we can see the company. Amit, do you want to talk about other considerations?
Sure, I can talk a little bit about that. Yeah, I think on the other considerations on transfers, we're in early stage. Our product is just hitting MVP. So as investors, we're going with, and we have a little interest right now. So we do want the investor to be, sort of fully committed to our journey as well. And so we don't think it's fair for investors to bail out of this one. So it's either transferred by the investor not permitted, or with, explicit approval on our side. On preemptive pro rata, we felt was fair for the investor. So that's what we've gone with. On Dragon, we're a little flexible on this one, and seeing sort of the term sheet from that side. I think we'll be okay with, more than 50% preferred stock holders agreeing to this, and we're okay with a 6-year drag. So while this one says no, we're actually in our framework, we're a little okay on this one, and we can spend more time when we talk. On I think on anti-dilution, we felt broad-based was the fair one for us as founders. So that's what we've suggested, and we want rights to tag along if the investor or a group of investors forces a sale. So that's broadly where we are. And the cap table, you can see in column G. This is 75% for us. I think the only change here would be 10% ESOP, 10% ESOP pool, 65% for founders, and 25% for PLV. So that's the cap table, what we received from PLV as well.
Cool. So
sorry, Mani, just to interject here, Amit and Aniket, what all points are you negotiating on other than the vesting? Everything else you are accepting of the term sheet, right?
I think the board seat, I think they asked for an observer. We don't think it's necessary. Yeah. We can keep that for probably some kind of mentors or advisors that we have later.
Okay.
So we can have one board seat given to the investor.
Okay.
And vesting is, they had suggested 4 years vesting from, I think we would like to go for 3 years.
Yeah. Got it.
But we gave 25% upfront, so I suppose that's not a bad middle ground. Yeah.
I think then it makes sense. 70% or 4 years. We're flexible on that.
Got it. Good stuff.
All right, cool. These term sheets are pretty close to each other. So are there any questions or any ask from either side? Can talk to each other, I guess.
Do we have a deal?
Yeah, it looks like we have a deal.
Awesome. Congratulations.
It was pretty.
Yeah, we're gonna go for a round of drinks, guys. So we'll see you.
See you at the pub.
All right. So Pratik, you want to?
Yes.
There are no other questions between the teams. I think Pratik, you can take over.
Yes. So you guys. So first of all, the term sheet was very, very fair. It was very straightforward. It was very fair. And if I was negotiating on behalf as an entrepreneur, I don't think I have extra points. The few points Amit and Aniket that you were negotiating on, a lot of these points are really not worth negotiating. बोर्ड ऑब्जर्वर ठीक है दे दो ना, मतलब उसकी तरफ से 2 मेंबर आएगा और नहीं भी आएगा तो भी मतलब एक एसोसिएट साथ में आएगा तो हाउ डज इट मैटर टू यू? So that's that board seat के लिए negotiate किया सकता है, but board observer के लिए negotiate करना it's not as useful. And secondly, on vesting as well, as you said, they are anyways offering. He actually offered a better deal at some level where he said 25% पहले cliff थे, 25% शुरू में vest कर देते हैं. So it's actually a better deal. You are negotiating against yourself when you asked for it. On monthly vesting is non-standard. That's why people don't do it. So there's no point negotiating. If they were actually giving you a better deal, there's no point negotiating in my mind. It's well accepted. Now, just for the sake of intellectual honesty, what I would do is I would go through all the points and describe why people don't do some of the other things. It's more for the sake of intellectual honesty. So let me Yes. Are you able to see something? Are you able to see the screen? Awesome.
Yeah, Pratik.
Yes. So, as Arun, you mentioned that that you fix the valuation at 3 million, and the reason you do it, just for the sake of clarity, is that typically there's no science behind investment. There's no science behind valuation at early stages. The way this works is there's an ask you have, and the ask is a function of how much money you need to get to the next stage. And VC funds have an ownership requirement. And ownership requirement typically is 20-25%. And based on that, you can come up with a number. And in this case, the number could be between 2.5 to 4 million. Now, interestingly, this changes a bit if you're operating with a, say, very large fund. And in that case, you can actually negotiate it very differently. You could say that, dude, why don't you take 10% right now? Because in the next round also, next time round also, you will be leading. So you can cover up on your ownership criterion in the next round. So many entrepreneurs negotiate with us that way when we are saying we'll take 15%. Is it next round bhi aap le lo, aap super predator le lo. So your ownership requirement will be covered up, and it's a difficult conversation there because anyways I did not have a logic to put 3 million or 4 million valuation. It was more of a story, and now you added another story on top of it. So now it's possible that I need to bite the bullet at $5 million valuation, $6 million valuation. So that's how typically it happens. Of course, it is always a supply demand game. If there's too much supply of capital, then valuations increase and the amount also increases. Even if he was asking $1 million, he will ask for $2 million, and I will have to pay up. So that's the way this dynamics will typically work. Now, this one discussion we should have is on an instrument that that both of you did not talk about as much. Now, of course, CCPS is the most standard instrument, but in cases where there is total misalignment on valuation, in that scenario, convertible note can also be figured out. So, for example, let's imagine this: if I was starting a company today, what valuation would Pi give me? I could make an argument that people, because at the end of the day, I'm just a person with a resume right now. I've not done anything, right? I'm just thinking about ideas. So one argument could be made that people of my type have raised at $15 million valuation. The other argument could be made that in my space at idea stage, companies are funded are given $2 million, $3 million valuation. There's complete misalignment between $3 million and $15 million, and there is no way the deal can happen. There is no way the deal can happen. But Manish cannot give me an argument that 3 million below. However, one way to fix this, and this happens more in very early stage deals, family, friends, and this could be a friendly deal, right? This is not a pure financial deal. Manish knows he wants to work with me. I know I want to work with Manish. So there's limited fight here. It's more about coming to a number, and that number is not logical to reach here. So one way people do it is to add convertible note. Convertible note would say that the valuation will be decided as a discount of the next round. Now, if the next round happens at $20 million, $15 million, then I was right, and Manish will get my shares at $10 million, $12 million valuation. If I do not perform as well, and the next round happens at $4 million valuation, then Manish was right, and Manish gets the upside of the risk, which makes sense. So convertible note could, at least in this stage in the company, convertible note could have been a fair discussion to have. And one negotiation that the startup team, Amit and Aniket, you could have done is, yeah, I don't think valuation makes sense because the other guy is giving me a convertible note, and because you are too bullish on your company, you believe कि next round to 50 पे ही होएगा, 25 पे ही होएगा. So and then Arun does not have any other option but to say either I am dropping the deal or I am also going to give you a convertible note option. So that could be a very fair discussion, a very fair fight to have, and it's not at all wrong on the startup side to have it. If there is demand and there is competition, then the VC will have to supply.
I had a question. If I'm a VC and I see the startup has a lot of inquiries incoming coming from a lot of VCs, how do I with that on the terms of investment? Like what can work in my favor in that direction?
Sorry, yaar, आवाज थोड़ी सी मतलब zig आई, so I'm not very clear.
I'm saying if I'm a VC and I have a lot of, the startup has a lot of incoming coming from different VCs, how do I still play it to my part that I can have a better terms of investment?
So here, in most cases, the founders will ask for it. The founders will clearly tell it to you that मुझे लगता है ये होना चाहिए, and based on the body language, you will understand what is happening. Secondly, it's never only about the terms that you win the deal. I would argue all the deals I have always see, all the good deals would have competition. All the deals I have won as Nexus, everyone had term sheets that significantly higher valuation, but they chose to work with us. That would always happen at the fringes. So of course, it's difficult to make it work at $3 million and $50 million difference. But entrepreneurs also know that they want to work with people who are most passionate, who are most committed, and who would work with them and would do ref checks on the VCs and then close the deal. I would tell my story to the entrepreneur that this is not that some other firm would be doing 20 deals a year. I'm doing 2 deals a year. So I'll be more involved with you. I'll give him ref checks on my founder who will thumb the table for me that these guys have been the best VCs on the cap table.
Got it.
I will. So all that at the end of the day, you are as an entrepreneur, you understand it's a very lonely journey and you want someone who is passionate about you. I would lose a lot of deals which I'm not passionate about, which are transactional deals. But it's a shame if I lose a deal that I'm truly passionate about, because the founder could not see my energy, see my passion, and see my love for the company. At the end of the day, it is a human transaction. It is not a transactional way to do it. It is a long-term journey, and people are willing to. And that is why, one feedback I would have to the entrepreneur and VC teams both here, that in your term sheet discussion, you appeal to the fairness of the other party, but you did not appeal to the passion and to the emotional aspect while discussing the term sheet as well. Every discussion has to be about the company. You have to show that love, you have to show that passion, you have to show that energy when you are negotiating. It is both of you. Well, we see more, Arun, more. You are more on the defensive, as if people are there to kill you. People want to work with you. People have to work with you. You are bringing in something on the table. It's not just money, right? You are bringing in energy and passion as well. And the founder genuinely needs that. He needs believers. Are you a believer or not? So that passion needs to come out in all the discussions. It should never be transactional. Otherwise, wo khatas aa jati hai relationship.
Good point, Pratik. I think here we also did not know too much about the company. So being passionate in terms of pitching or rather making the offer is a little difficult. I think what we were going for is, by and large, just be really fair, because that's also another way in which you can appeal to their emotions. One quick question I had about the convertibles. We were also tempted to go that way because there is a lack of validation right now, right? Product market fit itself is like a few quarters away or something. So do you think that's also a good case for a VC to then stick to convertibles rather than?
Yes. So, again, I would argue you might not want to do convertible. You might want to do shares only. See, if as a VC you are not comfortable giving a valuation number, then what are you doing? As a VC, you should be comfortable giving a valuation number. I'm arguing that the entrepreneur would probably negotiate more on the convertible side. And if entrepreneur's expectation of valuation is too high, then you would think that convertible is better, right? Because I cannot give you a term sheet of $15 million valuation. So let's do a convertible. So then it will come to you. But for you, if you are choosing, I would always prefer to choose shares over convertible, because it's my job to provide a number here. Why should I be worried about it?
Pratik,
right. But the prevalence of convertible is far more in the very early stages, right?
Very early, exactly.
So this also sounded like a very early stage deal.
Exactly.
So may I just add to that, right? So essentially what happens is that, let's say we don't know how the company will grow, and there are two possible scenarios from here. One company does very well, and company does not do very well. If I don't price it early on, right, and my pricing is based on the discount, and in case the company does well, I as an early stage investor don't get the enough leverage on the risk item, right? Because that will be closer to the next round valuation, maybe 15, 20, 25% discount, right? So I will lose out from that perspective. Whereas if the company is not doing well, then obviously it will be closer to the price round. But then anyway, the company is not doing well. So in your good cases, you may actually lose out in taking the risk.
Yeah. So again, when Manish said it, the way I will fight against Manish is that, well, why don't you do this? Why don't you do a convertible with a cap? तो एटलीस्ट 2 और 15 का जो डिस्कशन कर रहे थे वो 2 और 5 वो 5 और 15 में हो गया कि आपको 5 पे तो मिल जाएगा, आप खुश रहो ना, मतलब 15 आप नहीं दे सकते, 5 तो देना चाहते हो लेकिन आपको 5 भी नहीं देना, तो एक काम करो 5 का कैप रख देते हैं, तो दैट वे यू आर सेफ.
Right. And negotiating a really deep discount, does that happen, or is it always 20%, whatever you said?
Yes, so typically I have only seen 20%, 15%, 30%. I have not seen anything significantly lower, because again we are talking about very early stage deals. Next round would happen at 15-20. If you're doing 70-80% discount, then the difference becomes like, you're talking about $3 to $5 million range. Yeah. So then how does it matter?
Right. So cap is a better solution. Yeah.
Cap is a better solution. Yeah.
There is one more solution which I'll come to towards the end. Just in the interest of time, we'll move forward. I'll come to how tranching could also be used in very early stage. So we'll give you a couple of examples of that.
It makes sense. Perfect. Now liquidation preference. Yeah, both of you mentioned 1x non-participative just for the sake of intellectual honesty. So in the first round, like this is happening, it is fair to write 1x non-participatory, but there is a discussion that happens when a second round is happening, and that is whether the liq pref should be pari passu or senior. So some guys do it senior, which we in fact 4-5 years back senior was the most common norm. 6-7 years back senior was the most common norm. Somehow these days everyone does pari passu, which is better for me as an early stage investor, and definitely significantly better for Manish as a very, very early stage investor, because when I come after Manish, just for the sake of clarity, the difference between pari passu and senior is that when I come after Manish had put in 100 rupees, I had put in 200 rupees. The 300 rupees are at the same level. So if the company gets sold at 200 rupees, then Manish gets 60 rupees and I get 130 rupees. Manish gets 66 rupees and I get 130 rupees. While in senior, if the company gets sold in 200 rupees, I get the entire 200 rupees. So all the preference shares in pari passu are at the same level, which is better for early stage investors, because if the company does not get valued very highly later, then I'm screwed. Now, in super late stage deals where the guy is putting his job on the line by giving a large valuation, in those cases they might still ask for 1x senior, 1x liq pref non-participatory senior, and that is still okay with me. In many cases that happens, and you know it happens a lot in these payment companies. So in payment company, people say that you'll almost sure not lose money. There's no way you can lose money. So ek kaam karte hain, I'll give you a $500 million valuation. I'll give you a $1 billion valuation, and I'll put it $70 million, $80 million, but I have 1x liq pref senior. Then people are safe. That the late stage the early stage investors and the entrepreneurs get the ego boost of I have a unicorn on my books, but the reason they have a unicorn is that last round happened at 1x liq pref senior. So that investor knows कि कुछ नहीं हुआ तो 200 में तो बिकेगा भाई, तो निकाल देंगे. It's okay. Yeah. ESOP.
So just one question on that, Pratik. So a subsequent round, the investor can take a senior position, which means how do then early stage investors, is there any way for them to prevent this? Can they dictate terms which say subsequently nobody can take a senior position on us?
Yeah, anything that you say subsequently this cannot happen, it will always be negotiated. Every term in the term sheet effectively can be negotiated later when a new investor is coming. So you can never say this will happen in the future. At the end of the day, all the rights are with the board and the founders, right? So you can not do whatever you want to later. But if the company needs capital, then the next rounds investors will ask for what they want to ask for, and depending on demand supply, will give what you can give or not. So you can never ever. In fact, all these terms are effectively renegotiated later. In many cases, when we come on the cap table, we say, dude, all the contracts that you have are just unfair to the company. Make us the bad guys. We will fight with everyone, but let's fix everything.
Got it.
So you're saying that one should not worry too much about whether this will reduce attractiveness to further investors?
No, actually, one should worry about these things for a very different reason. If you gave me some right today almost surely in the next round, when new investors are coming in, they will also ask
with
for
the
those
same
rights.
rights. Okay.
So you are actually more screwed. And that is why, as early stage investors, we are the way to negotiate a lot of these things is, Pratik, you are asking for this right. I am willing to give you this right. I trust you. By the way, a lot of these discussions are, don't you trust me? That why do you need this right? Don't you trust me? So the answer is, dude, I trust you. I would want to give you the right. But the problem is, if you get that right, then the next investor will also ask for that right. And that's a problem for the company. And that is why, as we'll discuss, most rights that we ask for are never individual rights or veto rights, that Nexus should have this right, I should have the rights. We always say that it should be joint right, that more than 60% of preference shares should have this right, because otherwise, if everyone has the right now, then the company is in shambles. We never want everyone to have any right, and that would mean giving up a lot of my rights, and I'm okay with it.
Makes sense. Yeah.
Yeah. The next point is on ESOP. So you made the right point here, that it typically 10%, and in typically, so if there's no co-founder in the company, or there's a critical skill that is missing in the company. So example, there in lots of companies which are very heavy media type companies, or which require celebrity management type companies, people are arguing that we'll do deals but give 20% ESOP, because 15% will go to a senior guy who would manage celebrities. Or this happens when you don't have a CTO, and then we give 20% ESOP extra for the CTO, and sometimes it's written specifically, although it cannot be written in the ESOP policy document, but it's written explicitly in the term sheet that 20% is for CTO, 5% is for this, and if CTO does not come out, if CTOs take less, then this part will come back to this. So it's explained in detail, although this cannot be explained in the ESOP policy document, but it does not matter, because board reserves the right for ESOP for ESOP management anyways. But this is more for a mutual understanding between the founder and the board that this is what we discussed. So it could be 5-6% as well, but in this case, almost surely if there are 3 founders, then they would have complementary skills. And as you mentioned, it should be 10. The founders could negotiate 6% as well. Key 6 is also fine. 5 is also fine, because we cannot imagine what senior guy we need in the company, because all 3 of us are complete for everything anyways. Board of directors.
It's not exactly a one-time exercise either, right? I mean, you can keep adding to the ESOP pool.
Yes, but right now when you are doing it, this is happening. 10% is post. 10% is post the round. Otherwise, I'm also getting diluted for the new ESOP being created, and that's why I would prefer to have more ESOP before I come in than later. In fact, even in next rounds it would happen. So sometimes the way this works is I'm talking to an investor, and we negotiate a valuation, say $200 million, and we shake hands informally, and then he'll while he was giving the term sheet, he will add that ESOP pool should be increased to 10%. Now that effectively means that he did not negotiate a $200 million valuation; he negotiated a $180 million valuation.
Yeah.
And then again, we go down those cycles. We have to have that discussion again. That dude, you have to. We discussed $200 million valuation, and we did not want ESOP. Otherwise, effectively, this is 180. This is a flat round. Last round happened at 120. Why are we doing this?
Mm-hmm. So yeah, ideally the VC would want to make sure it's a one-time exercise, whereas founders would always say that, why you dictating this to me, I can always go and expand it later, but that comes at the cost of my dilution. So that's the tussle between VC and founder in this scenario, right?
Hello.
Yeah,
Pratik, we can hear you.
Go ahead.
I'm losing. Just let me switch.
Yeah.
Can you hear me?
Yes.
Awesome. You're right. Board seat, you're right. In general, it should be small as possible. In general, it should be as founder friendly as possible. At the end of the day, these things matter when the company is larger. For most VCs, it does not matter. Anyways, if the founder does not want to give you exit now, he'll not give you exit. You cannot do anything. So at early stage, it does not matter. And late stage, these things are important to have rights to fight against other investors' dynamics, because other investors might have a different end game because of the time they came in and because of their risk appetite, and that is why it becomes important in the long run. So this is fair. vesting we discussed
Can I just
how to do it.
one point, Pratik, on the
Ha,
board part?
ha.
So just one small consideration here is that typically all founders are on the board, typically, right? So I think one of the term sheets said one founder will have the board seat. Typically, most founders will have board seats. Second is the way the board should work. Ideally, is that early stage investors, and this is something that informally you can get a sort of a buy-in that suppose I'm doing a seed deal, but by the time the company hits Series B, the early stage investor is expected to convert his board seat into a board observer seat or let the board seat go. Otherwise, what happens is for every round you end up adding a one board seat, and then it becomes little lopsided in terms of investors. So that's another aspect. And that's why one of the reasons we do is that we ask for a board seat and a board observer so that we can let go the board seat, when the right time comes.
Makes sense. And by the way, this is a unique perspective because Manish comes in at a very, very early stage and he would almost surely not maintain ownership over time. I never, this is just good to absorb this dynamics here. I never think like that because in my case, I would never let go. Almost surely I'll not let go my board seat because almost surely I would put money in later as well. And I would maintain my 15, 20%, 25% ownership. So almost surely I will never let go of my board seat in that context. And the other, but sometimes it is written that board seat is valid, will be taken away when the dilution happens and your equity is reduced to something below 5% ownership, then the board seat goes away. On the vesting part, I'll just add one small point. Although you know this, we have discussed about this, but this was surprising to me that vesting does not mean that you have the shares as founders. Vesting, even after vesting, the equity is kept in an escrow account and not given to the founders. It is sort of too protective from investors' perspective. But the reason it's done is that once you are given shares, then legally it's very difficult to take it back or cancel shares. So the reason it's kept in escrow account is that if there's a cause, and cause would be illegal behavior or poor performance or whatever those things can be specified. But in that scenario, the investor has the right to take back even the founder's vested shares. And it will be difficult to do once the founder has those shares in his name. And that is why those founder shares are typically kept in escrow account. It's a very extreme scenario, but this just is better for company, this is just better for better corporate governance and nothing else. But this is an important point to note that, and many founders fight about this, that why should I not have, why should the vested equity not be with me? Why should it be there in equity in escrow account? And the counter argument to that is and the argument they would give is, don't you trust me? Do you think I'll steal? Do you think I'll do something illegal? Well, you'll not do anything illegal, but as a board, I have to manage. I have to get corporate governance right, and that is why this becomes important sometimes.
So,
is it
what
fairly
is the
standard
procedure to get those shares back? Like, is there a board approval or something that is, or some kind of call that is required?
Yeah, so first question, is it standard? It is standard. I have in all term sheets I have seen, in all, it's not typically written in term sheet level, but at all at all definitive documents I have seen, it is always it is standard. And the other question was, in any ways the founder shares are as we discuss about permitted transfers, are under a lot of restrictions. So it will have those restrictions even then. So once you have board approval to sell or etc., then anyways the shares will come out of the escrow account and then they will be sold, given to the founders, and then they'll be sold. So nothing practically changes other than the fact that legally it's not as big a hassle now to manage. Legally it's not big a hassle. In case I want to take back those shares, there's a simpler legal recourse rather than taking back the share capital and cancelling those shares. It's just there's more hassle in doing that. Awesome. Now let's go to the more interesting part. By the way, this is longer because the next one almost have all these considerations. So it's okay to spend more time on case 1. Case 2 will be faster because all these things will be discussed there anyways. Right? So,
I
so
just add one
yeah, Manish.
part, right? So in a seed deal, so they have spent 1 year in the company, but it is not necessary that you give 25% vesting for it. I think resetting the curve is quite normal, and and the reason why it is done is sometimes founders leave the company, and it becomes hard for other founders to cope up with it, etc. And you need that equity, right? So in this case, it is fair, actually, in my opinion, to say 0 vesting and 1 year cliff, right? You could start from 0 vesting and then do a 4-year curve also in this case.
Fair enough. In fact, it's actually worse for founders sometimes, that even after Nexus has come in, when the next investor comes in, he also then asks for reset of the vesting schedule, and which is fair from the investor side here, because I'm investing on you guys, and I'm hoping that you'll be there for the long run. And then if you're leaving in between, then what do I have? And Indian startup ecosystem does not have this as a big issue, in the sense that people are not leaving at will without any reason. In most cases, you know that the founders will stay until there is fight or something, which will anyways be managed in a different way. But in many startup ecosystems, I have seen that there is an expectation that one or two of the founders will leave in a year. And that's the way they live their life. That I'll have 5% equity in a company every year, and one of them will succeed, and when it will sell, I'll make money. That's a part of their life. In India, all entrepreneurs are more passionate and more. It's not as transactional, because it takes longer to build a company. So people are more committed I would sense, and that is why this is not a big problem in India, but in China, for example, it's a big problem. And people worry about it much more. Whenever we are investing, when we are investing, it's very early. But whenever a let's say investor is investing, he actually looks at the cap table and says, "Acha, the main founder only has 5%. Will he stay? Should we top up?" And that's a very important consideration. And that's why vesting also is important. Oh, all these guys have been vested. So should we top them up? Otherwise they'll leave. And if they leave, then will the company grow as fast as it's growing today? So this becomes an important discussion then as well.
Can you talk about this topping up concept? Like, what I've never heard. What happens topping up?
So yeah, this is very standard in US markets. In India as well, this is becoming more standard. See, companies get diluted over time, and founders, in many cases, after 10 rounds of dilution, are left with 2%, 3% equity. Now, if you think about it, even at $1 billion valuation, the founder would make $20-30 million from that company, and maybe he's getting $1 million salary. Then what is he thinking? I don't know if the best founders get $1 million salary, but the argument I'm making is, if you are making enough money as cash, and you lose trust or hope of making it big from the equity, then are you incentivized to make the company successful in the long run? This becomes even worse when you are allowed to sell equity in between. So if a secondary has happened and I have made $1 million, my secondary happened, I made $10 million. My salary is $500,000, $1 million. Then why do you expect me to be motivated for the rest $15-20 million that is left? Because as the company is being diluted more, my equity is not as valuable. So in that case, the way it's incentivized is you take 2% equity more, and investors and everyone will pay from their pocket in some way, because everyone is diluted. You take 2% more, so that you are more incentivized to run with the company, and it's all fair. At the end of the day, founder is building the company. It was unfortunate that he got diluted because of the rounds that happened. And as a board, all of us can decide that for the long-term success of the company, and because that's only when we'll make money. It's okay to give up something for the founder to be incentivized, and he's anyways doing the most and giving up the most. So it's okay for him to be. It actually works in favor for us to give up something, so that he's incentivized and he works hard and kills for the company.
Got it.
Pratik, I had one question around the liquidation thing. You mentioned seniority, right? Now, as an early stage investor, how can I protect against a scenario where another investor may come in later, and this person can negotiate a seniority deal, whereas I don't have that seniority. So eventually it'll look like, somebody else who came in later has seniority, I don't.
It's okay. You cannot negotiate against that. It will happen. You will get whatever you can. You cannot protect yourself against future deals. Because at the end of the day, once you are on this side, you are working with the company and you are there to make the company successful.
And one additional point on that is, right, if there is enough money on the table, it doesn't matter. Only if the money is tight at the exit, right, then you will lose out.
Yeah. Right. Okay. But I can't bake it in at this stage itself that you will not work with any investor who will not take seniority.
No. See, you cannot. We say this often that if a lot of these discussions, and of course Samik would know this much better, but a lot of these discussions, if it comes to looking at the paperwork, then you are anyways in a different zone. Most of the discussions that investor and entrepreneur are having are not around what would happen if that negative things happen. It is important to have in the paperwork, but no one thinks like that. Future में करने नहीं देंगे. Whatever would happen, we are in the same boat. We'll do what's right for the company.
Pratik, one question here. Like, have you had any time? Like, have you had to deal with, let's say, an existing investor on the cap table who was not as sophisticated, maybe, and maybe the founder weren't too, and they did end up with a lot of aggressive rights, and now the early stage investor doesn't want to let go of those, and that's something that you can't allow or want to have as an incoming investor. So have you faced those situations, and what do you do in those cases?
So you're saying that the early investor had a lot of rights, and as an incoming investor, I don't want the existing investor to have those rights.
Right.
Yeah, that is easy. That is negotiable. When I'm coming on the cap table again, I'll ensure I can ensure that a lot of those rights are taken away, because again, all those terms are being signed again effectively because everyone is signing off on whatever deal we are doing now. So all those things can be taken away. In fact, there's a clause called MFN, most favored nation. So United Nations, the history of that clause is from a political side, I think, or diplomatic side. But what it means is, I will always get the most favored clause out across all parties of that bracket, of that preferential bracket. So that happens a lot, and that happens sometimes. It is not preferred. So we would prefer to not have a term sheet which has an MFN clause, but that happens sometimes.
And Love, we've actually faced one situation where the previous investor would not give up rights, and it actually became a deal breaker. We could not do the deal. So it does happen when they get stick on. Just as a time check, we are at 10:55, so we can move a little faster than we can do the other case study.
Yes, but Manish, the last part here for me at least, it's very similar. So if you spend time on this, it will be okay. The second case study can be done faster.
Okay.
So everything that you said, Arun, was right in the other consideration set. But let's talk about why people do the things that way. So in permitted transfers, typically the way people ask is typically the right people ask is, on founder shares I will have an offer, veto to sell, and co-sale. Interestingly, I don't have an offer on any other shares other than founder shares, and that is very important. The reason that is important, by the way, would anyone want to take a shot on why investors, why no one asks for offer, or founders should not give offer on company shares? It's okay to give offer on founder shares, but not on company shares. Anyone wants to take a shot?
They will become less valuable for whoever's holding them in that case. And so if they're in ESOP pools or otherwise, they're not as valuable. They're less liquid.
So yes, but that's very small reason.
There could be arm twisting in the next round by the initial investor, right? Where
that could happen, that would happen, and that's why it is advisable not to do it. However, there's a bigger problem with offer. If everyone in the market knows that Nexus has offer on that company shares, or issuance of new shares. That would mean that no other investor would want to give a number to that company, because effectively Nexus will have the right to put money at that valuation, and then it will just be a price discovery for the company, and all the work the new investor did would be futile. So from the founder perspective, Nexus having offer would effectively mean that I am stopping the company to raise a follow-on round later, which the company might not want. In case of, if I was a strategic investor, founder would ensure that I should not have that right, because if I have that right, then I can block all the funding that the founder would have, because no one else would ever give a number, and that would mean I can acquire this company for cheap later, which will be a problem. And that is why, especially when you are doing with strategic investors, offer is clearly off the table. Offer on company shares, offer on founder shares is okay. Offer on company shares is completely off the table, because then you can play games and get and acquire the company for cheap, because no one else will give any number ever. It's a very fine and subtle behavior thing here, that why should some other investor give a number when they know that after giving a number and after going through all that work and after having that chemistry with the founder, I'll not be able to do the deal because the internal investor will put the money in. Awesome. This was unique and interesting for me. The other thing is,
Pratik,
you talked about,
quick question. So the other type is right of first offer, right? ROFO. So as an investor, isn't it better for me to have that rather than ROFO? Because
no, ROFO is stronger than ROFO, because ROFO may ROFO. So in ROFO, the entrepreneur comes to me and says, "Give me a number," and whatever number I give, then if someone else gives a higher number, then he can choose to pick that number. While in ROFO, he comes back to me with a number, and then I can decide whether I want to give a number at that or not. Secondly, in ROFO case, he has to tell me that a term sheet has come. The existence of the term sheet is also an important thing here. While in ROFO, there's no demand here, right? So I have come to you first. So if I say give a number which is very low, because I know that the guy will not get a term sheet, then that situation can be managed. So ROFO is definitely stronger than ROFO. ROFO is okay to give, ROFO perhaps advisable not to give as a founder. And again, as a VC, I would never want to take rights, because I don't want, because if I have that right, then other people also will have that right. So I would prefer that none of us ever have it. This is just unfair for the company.
Mm-hmm. So does it happen though that if I have ROFO, I can, the way I understand is ROFO is where I make an offer, right? Right. Whereas ROFO is where I get to see an offer and decide whether I should refuse or not, right?
Yeah.
So in ROFO, since I can now call the price, can't I not call a high price and block everybody else? Doesn't that happen?
Well, then the founder will anyways be okay with it, and I'm giving a higher price. Then the founder will anyways be okay.
Yeah. No, my question was, as an investor, wouldn't I want ROFO rather than ROFO?
That's the point.
I can just call the price, right? Always.
But then ROFO I'll have to give a higher price. Very high price, because anyways the guy will be going to other investors after my offer, and he will get the highest price. So in ROFO case, he got something and I have an option to just fight against that. It's like you telling me I have to just give a number higher than you have, and you have a number 6 and you just need to give 6.5, rather than you telling me someone can give me anything, give me a number, and then I have to give you 10 because someone will be 8 as well, and I don't have a good fight. That's why ROFO is definitely much stronger than ROFO.
Okay.
Pratik, what is the motivation for an early investor to refuse for a higher or later round? Any scenarios there?
What is the reason for sorry, can you please repeat?
For offer to be activated by an early investor, like why would somebody say no?
So in early investors, maybe it's okay to give offer, but because early stage investors anyways are more closer to the company, are more building with the company, etc. But in early stage as well, say my peer funds, so if I have given, let's use it this way. In my peer fund scenario, I have given a term sheet. I'm on the cap table already, and I have an offer. A peer fund of mine, why would it want to give the term sheet to my company now? Because that peer fund would say that Nexus would then decide. It does not then rests only on the entrepreneur, where entrepreneur and the other VC shaking hands does not mean that the deal is done, because Nexus finally has the final call. Of course, in almost all practical scenarios, we'll never exercise that right. We will always want to play it fair with the entrepreneur. We'll want to keep the entrepreneur's word. We'll want to if entrepreneur likes someone, we'll make sure that all of us are building the company together. So almost surely I'll not exercise it, and that's why in early stages it does not matter. Most of these things will not matter, but in late stages it becomes very important, and founders should be watchful of the offer clause.
Okay.
So what I was asking earlier, Pratik, in case it wasn't clear, was as an investor, my shares should be subject to ROFO rather than ROFR, right?
As an investor, my shares.
So if I want to transfer, if I'm an investor in a business, and if I want to transfer my shares, it's good for me if I have a right of first offer rather than.
Of course, I agree. In fact, as an investor, as an investor, typically I don't have any such clauses as well. I don't have ROFO on my shares as well. As an investor, typically I would want to keep it very open-ended, because I should have the exit rights. If someone else has the option to stop me, then it's a problem for me. And we'll discuss this on this in this tag along right later. That no tag along works with investors. Typically, investor shares don't have tag along, because if I am there on the cap table and say a super large tiger is there on the cap table, I would not want my shares to have a tag along, because I don't Tiger to have a tag along with me, because I don't want a situation where when I'm selling, Tiger also needs to sell, and then effectively I'm saying that it's not 20-25% shares. I don't want a situation where when Tiger is selling, I'm not able to sell. So tag along typically is not on investor shares; it's on founder shares. Because if the founder is selling, then I should have the right to sell. But if everyone else has the right to sell, then I'll never be able to sell. So investor shares typically do not have tag along. And the same thing, similar. You talked about drag along in the right way. Just clarifying this again. No individual drag along right is given to any investor, because I do not want a situation where that other party, whether it's because of different incentives, because it needs to show exits, or I don't want the company to be at the mercy of every individual investor. And that is why the drag along right should not be given to every individual investor. It should be perhaps as a majority of preference shares or something like that. Anti-dilution broad-based, we talked about. Almost always it's broad-based. So nothing for me to add here. Happy to answer any questions.
In regards to transfer of investor shares, particularly when you have now a lot of investors on the cap table, at that time, in addition to ROFO, do you guys see any sort of other restrictions, like not selling to a particular competitor or particular group?
So that has started to happen at our level as well. But at our level, of course, founders are more collaborative. But in late stage, definitely it will happen. In the permitted transfers list, it is written that you typically make an exclusion list of 5-7 people, that no investor can sell these shares directly or indirectly to these 5 people as well, without board approval, without a majority approval. And this exclusion list is also sometimes used to say no investor should be allowed to have ownership in these 5 companies.
Okay, got it. Thanks.
Pratik, on the pro rata, what have you seen in terms of pro rata for lead investor versus other minority investors? Because I think for the lead investor, where there could be more alignment and more ambition, it does make sense. Does it make sense for it to be present for every other minor investors as well?
Yes, typically we will.
more restrictive.
Yeah, so typically everyone gets pro rata, and the reason again, if minor investor is there, his pro rata amount will be significantly smaller. So anyways, people don't worry about it as much. Sometimes super pro rata is enforced, and it's enforced in such scenarios. Say two investors were coming in, and suppose Nexus and Pi were coming in. Pi says I want 15% ownership, and Nexus says I also want 50% ownership, but the founder does not want to dilute 30%. Pi can still say, यार मैं अगले राउंड में नहीं डालूंगा तो इसलिए 15 मैं ले लेता हूँ तो ठीक है एक काम करते हैं why don't you have 15%, let Nexus have 10%, but then I don't want to be in a situation that in the next round I don't even have the chance to increase my ownership and some other VC comes in and he takes 20% and I'm just sitting over there with 10% ownership in a company which I wanted to be a part of in a big way. So the solution for that is me having a super pro rata right. Of course, this makes it challenging sometimes for the fund for the entrepreneur to raise follow-on money. So that's why this should be discouraged, because the way this will work is that if I have a super pro rata right where I can increase my ownership by 10%, say, that means that the new investor, if the founder has a dilution considered of 20%, then that means the new investor will only get 10%. And many investors will say, if I'm getting 10%, I don't want to come in. Of course, in that scenario, because I want the company to succeed, what I would do is I would say, let's do the deal. I'm willing to let go of my super pro rata right. But then it's a very personal discussion that we are having.
Yeah.
But I still have the right. So then what's the point of the right if you know that you're not going to exercise it?
Yeah.
So it's murky that way. But I've not seen people give up on their pro rata right. I've seen some people ask for super pro rata, which is fair in some cases.
Just for sake of completion, we've seen some term sheets, not in the first round, but in second or third round, where there is a cap on the ownership or the amount invested beyond which only you get the pro rata right. And that is not done to discourage participation. It is just done for, it becomes easy for founder to get the round together. Otherwise, there were 20 people sitting on the cap table. They have to go and get approval from everyone and amounts for everyone. So we've seen those cases as well.
Makes sense.
Okay.
And this becomes especially messier, just to complete Manish's point, this becomes especially messier if there are 20 investors and if in $100 million round, people are talking about putting $500K, $1 million, $500K, $1 million, because they just had the right. It just becomes messy to manage. So it makes sense.
So I think we're done with the discussion of this, Pratik.
Yes, let's do it.
I just wanted to add one point on the tranching and then we'll move to the next use case, case study, sorry. So
I just had one more question, Manish, if that's okay. So in tag along, right, we defined it as greater than 1%. If the founder is diluting more than that, then you can tag along. Typically, what is the thumb rule here and why impose this kind of a threshold at all? I mean, we put it because we sort of thought it was best practice, but this is, I would admit, slightly poorly understood. Can you just explain why you need a threshold like that?
Yeah, so this is effectively, think about it, this is at some level, this is a veto on top of board approval. At the end of the day, I anyways had the right to stop the founder as a board to sell shares. Because as an investor majority, we could decide whether the founder sells shares or not. But if the investor majority has decided that the founder can sell shares, and I want to sell my shares with the founder, then I should have the right to do this. Tag along is an individual right, while the transfer restriction was more of an investor majority thing. So that's why it's written specifically. Now, the reason it's done, and a lot of times it's also written in change of control scenario, I have a tag along right. Because if the founder is selling 1%, then it's possible that I don't want to be involved in the company at all anymore. So I want to ensure that I want to get out of it and take my money out. How do you enforce that when the board has allowed the founder to sell 1%, but I as an investor am not aligned anymore? Or one founder is leaving, one founder has been fired, one founder has met some unfortunate incident. I don't want to be involved with the company anymore. It's better for me to just get out of the company, and this right allows me to exercise that.
Okay. So the threshold of 1% or whatever is where
is
your red
because of
flag
that.
kicks in. That I'm
Ha,
gonna
ha.
All right, just a small comment on tranching. So in couple of transactions, what we did is when it was a very early stage deal and we still wanted to get our 20-25% ownership for $1 million plus minus, but not comfortable putting the entire million in the first go. Then we've actually worked with a couple of founders. We've created a milestone that, okay, let's do 300K, 400K now. And in a year's time, if you get these milestones, then we'll put in the rest on the same transaction. Right? So we've done that 2-3 times. It has its own pros and cons. If there is time, we can cover that later. All right, so now let's get the TQV guys. Who's the spokesman? Can you guys come up and present your term sheet?
Yeah, Manish, I'll do that. And can I share my screen?
Yes, please.
Yep. Is my screen visible to everyone?
Yes.
Perfect. Yeah, so I think Pratik and then the guys before have gone through each term. So I won't go into detailed description. So for the 2 million round, we've come up with the pre-money valuation of 7 million. Where as a smaller fund, we can't take the entire risk. So we are going with 1.1 million. The reason being that we want to be seen as the lead investor. So that's why we are covering 55% of the round. Preferred stock as because that's the standard. 1x non-participating liquidation preference. ESOP pool, I think we've gone for a bit higher, so that right now both us as well as the incoming investor don't get diluted, and there's no future dilution required to create an ESOP pool as well. So I think we've gone for a bit on the higher side. Board of directors, we were just asking for one board director seat. On the vesting, because the round happened a year back, where there was a cliff. So for this round, we are not insisting for a cliff, but for the 4-year quarterly vesting schedule. So the founders get whatever they were supposed to get as part of the previous round's cliff. On the permitted transfers, pretty standard. Lock-in and transfer restriction on founders for 4 years. Our right of first refusal. And on us, we would have no transfer restriction apart from a few specific entities. Pro rata rights. Drag along rights, I think with the simple majority within 5 years, after 5 years, we can enforce drag along. Just to be fair to STM, we've put a floor on this by saying that it would be at a valuation of at least 3x, so that everyone gets to make some money. On tag along rights, we've gone for 5% of the founder shareholdings instead of 1% as was seen in the previous deal. I think that's we've been more fair to the founders. And on the anti-dilution, I think we've been a bit stricter, where we've gone for a narrow base weighted average. In a couple of other terms, we've said obviously these would be negotiated in the future, where no better terms would be offered to any other investor without our approval, and we would be pari passu with any existing or new shares. Based on that, this is the updated cap table, where we end up with about 12.2. The co-investor coming in with 900K also ends up with a double-digit equity stake, which I think would be important for them. And the founders are close to about 50%, hold about 50% of the company after this round. That's about it from us.
Awesome. Thank you very much. And thank you for presenting it so quickly. Can we get the founders to respond with their own version of term sheet, and then we will see how the disconnect is.
This is more complicated, so we should see more.
Yeah, that's right. So yeah, Arushi, you're going to do that? Awesome.
Hi guys, yeah. So we are team Shooting for the Moon. We're here to present you with our blood, sweat and tears at this point. Just starting out with, we're a well-balanced, solid team. We're 3 founders, one of us coming with a solid product and operations experience, 1 solid tech and 1 solid business. 3, and the best thing is we're all coming up with X startup experience. So we've learned from our mistakes, and now we're presenting to you 3 years into this company where we're showing a product market fit, we're showing we have a product in the market, we have paying customers, and we're showing early revenues as well. So with that, hopefully to come out with a gentleman's agreement, I will present our term sheet. Funnily enough, you gave us better terms, so I think we're going to go with a lot of stuff that you have proposed. Okay, so we said our pre-money valuation.
We are a fair VC lot here.
We gave our pre-money valuation at 4, given that our previous round, we had an investor who put in $1 million for 25%, but great. We're, then an investment amount, I think that the case mentioned it was 2 million. So not really sure where that off is. Then the investment instrument, preferred shares, liquidation preference, we're gonna go with what you mentioned. Non-participating works for us. ESOP, again, we put in a 10%. We wanted it, not that we're confident in our founder as a cohort, but we wanted to keep some percentage for the employees that we want to bring in to help this grow. Board of directors, 1 board, vesting fairly standard. Permitted transfers, we wanted the first right of refusal for the founders. Preemptive rights, pro rata. Drag along and tag along, both yes, but for the majority stakeholders. Anti-dilution, weighted average, broad-based. And that's the overall term sheet. There are a couple of things that we wanted to bring into play just for us to understand, to be honest, and Pratik, you can help us here. But there was a pay-to-play cause that we came across that we would love to know more about, and I think it favors the founders in a way, especially in a down round. So we would love to add that in. And a couple of just reserve veto rights, given that we're a company that's trying to go bigger, in the sense that we wanted small things like size or dismissal of board of directors, issuance of further securities, any distribution of dividends, any material joint ventures. These are small things that we wanted to add in that we would like the founders to have control over.
Arushi, just keep your term sheet on the screen, maybe go a little up.
Sure.
So our TQB guys, right? It's your chance to.
Yeah. I think I don't know where to start. I'd much rather take their term sheet now. I think I was being too fair and generous because their last.
We love your kind of investors. Fair is good.
Because their last post-money valuation was 4 million, and after that they've had early product market fit and traction with paying customers. So I don't know why they went with the flat round. So I just I sort of gave them a bit of a leg up I created a 15% ESOP pool, which meant that their pre-money founder valuation was close to about 5.5 million, which was about a 40-50% like a 40-50% raise from the previous round. And I think we went from that. Arushi, on the 2 million, I think what we've said is that the investment round would be 2 million. But as we are a smaller fund, as TQV, we will cover 1.1 million, and there will be a balanced co-investor because there is a lot of, let's say, interest in the company. The balanced co-investor would invest the remaining 900K. So that's the thought process, where there would be 2 incoming investors covering the 2 million rather than us picking up the entire tab. Yeah, and I think we've been a little bit strict on the ESOP side, and we would want to stick to that 15%. I think based on the valuation that you've said, I think you would still end up more based on our term sheet with the 15% ESOP pool. So I think on that, and even with the narrow based weighted average, you would still come out better if something went down, because so I think I don't know. I'm on the other side now. How do I negotiate against myself now?
Fair enough.
I have a quick question on the investment amount. Like, why did you choose 1.1 instead of 1.5? Like that's the caps check size TQB has done in the past also, right?
Yeah. So the thought process there was 2A. We wanted to leave. So actually, the main thought process was that we wanted to leave enough on the table for the other investor as well. So for the 900K at a 9 million post, they still get 10% equity. So if you would have left like 500K, they would end up with a very small shareholding, which would make which would make it difficult for someone else to come in. So we wanted to leave enough on the table for the other investor as well, so that to make the deal happen.
I guess, Manish, it would be, I don't know, I think the way our team understood it is that we're asking for, there's only one investor coming into this new round.
And that's fine.
You would take in, yeah.
I think that's fine. So I have one question for team TQV, right? Arushi, can you scroll up, please?
I'm as up as I can go.
No, it's down, sorry, down. I'm sorry. Okay, that's it, right? Team TQV, are you guys okay to give all these reserved veto rights to the founders?
Wait, no veto rights, pay to play, 12 months, size. I think some of them are fine.
Let's go one and let's do that because we have time. We can spend 5 minutes on this. This is important. I think Pratik will also cover later maybe on that.
I think, for example, dismissal of board of director.
Yeah.
How can it be single-handedly with the founder, but not with the overall board? Okay. If I understood, that's what this means. Reserved veto rights with the founders.
Yes.
Right? Yeah.
So you're right on that. I think for that one, we would go for the majority stakeholder or a board of director veto for the size of dismissal of board director. That's fine.
I would also question the credit lines and the loan agreement.
Yeah.
So our rationale on that was essentially that given that, so we assume that you are coming in with 2 million out of 4, so that's a third of our company. If for any reason you decide to, I don't know, make a big expenditure on our behalf, we wanted to be able to have some control over that. That's really where it's coming from. Again, here we are on the reserve veto rights. These were things that we wanted to make sure that it's a consensus or a majority decision as opposed to, the investor coming in and vetoing. That's all. This is our cover.
Okay. I think so. If it's with regards to, are you asking for a simple majority then for these rights, or what's the thought process?
So I'll be honest with you, we put this in the miscellaneous section because we just wanted to know how, in terms of a discussion, how this would go. And this was something for Manish and Pratik to sort of provide their input. I think as a fair agreement, it would be a majority decision or the board of directors decision on all these rights.
What do you mean by this is that you don't want the majority investor to have to against.
Yes.
So you want a majority vote. Yes. To be counted for these items.
Yes.
Okay.
And Arushi, are you okay to give the MFN right to the TQV team? They've asked for MFN right.
Was that a blank? Sorry, if you could jog my memory again. Was that a blanket consent on following rounds? So it says. Let me read it. No better term to any investor without TQV approval. Pari passu with any existing or new shares. So I think as long as it's not a automatic renewal or automatic consent for the next following rounds, I think the team, Jitin, Ashish, and I would be okay to discuss it and move on. Okay. All right. Okay. Anything else? Otherwise, we let Pratik come in and dissect this out.
I think we are good.
All right.
Awesome.
Pratik.
Yeah. So your answer from my side would almost be simpler. So let's debate on a lot of points that you guys talked about more. So Shubham, of course, your term sheet was very fair. A few points to discuss on, but can you bring your term sheet up again, Shubham?
Yeah. One sec.
Again, a lot of this is more intellectual understanding of the process. There's nothing right or wrong about it in Shubham's case. Arushi, I actually believe that a lot of things in your, like Shubham also pointed out, it was wrong of you to expect a few things. So let's discuss about it. But in Shubham's case, it was almost it's fair. It's more about discussing what could be done. So so pre-money valuation of 7 million. You know, the other party, for the sake of having emotional comfort and have a fair way to visualize how things are moving around him.
Yeah.
The other party could argue that last round valuation pre-money, post-money was 4.
Yeah.
So I want at least a 2x bump.
Yeah.
And that is why that is how the other party will think about it. It is in many cases not logical, but it sometimes the other party thinks about it or wants to negotiate on that basis, and you need to consider it. So I would think that 6 to 8 anything is fair from that perspective if the company has not grown significantly. In some cases, you can also argue last round portha, I want at least 3x bump up. So a lot of times it's unfortunate, but a lot of times founders and investors both think about last round valuation and providing a bump up to that, whether it's 1.5x, whether it's 2x, whether it's 3x. People think like that. So while you are presenting it, you could just present it that way. The last round was 4. It is 75% bump up from the last round. Already, which is a good way to articulate it.
And the pre-money of the next round to the post-money of the last
round.
Ratio.
Okay. Yeah, so the thought process here was that I'd actually left some room for negotiation where we were willing to go up to 8 million pre-money, but we wanted to start with 7 because we expected it to be a negotiation where they would come in higher. But as it turned out, we were higher.
By the way, again, this is a different approach that people take for negotiation. One approach that many people follow, and I think that's right, is that I always want to give my best offer to begin with, because that creates trust.
Okay.
If I am willing to negotiate, that means वो सब्जी भाजी वाली discussion हो जाएगा.
Okay.
You have to know that I am willing to give the best offer that I could, and I am willing to put my best foot forward.
Okay.
That is one way to look at life. The other way to look at life in this scenario is what is my must have, what is my should have, and what is it that I am willing to do. So for all the terms, I need to have understanding of my boundary conditions. Here I am willing to lose this deal if it's happening at more than 10 million pre. I don't think it's worth the risk. Okay. So before going into a meeting, good to have that clarity and good to have an understanding from your team that what is it that you are willing to give up on.
Yeah. Okay.
The other point, so bang on that maybe you should do 1.1, 1.2,
Pratik, sorry, I just want to add.
Yeah.
You have raised a very important point about going back with your best offer, right? This is a philosophy in life, and it also builds your reputation in the ecosystem of how you do negotiations. If people know that you are very open to negotiation, then they will come to you with a negotiating mindset and ignore your first offer in some sense. But people know that you have a reputation of doing a fair job, then they will also come at it with a fair stance over a period of time.
Yeah.
This is a repeat game thing now. So the way you said it, Shubham, I could make it 8 as well when a 7 se start kiya. Like that works in some scenarios, but in VC industry it's not as positively looked at, because again everyone will know us, everyone will have opinion about us without even meeting us. So it's important for us to be right and fair and do the best thing possible for us to be successful in the long run and not only in the short run.
Shubham, did you mean that 8 is my absolute high?
Yeah, 8
is that what you meant? Instead of saying that I wanted to negotiate, 8 was my absolute high.
So 10 million post would have been my final sort of a thing. So
both approaches work. It depends on what type of reputation or what type of relationship you want to build. Both works. There's nothing right or wrong about it. Investment amount, you are right. You cannot do 1.5. You cannot do more than 1.5. So you said I wanted to do 1.5, but I'll do 1.1 so that the other investor also has 10% ownership. So good solution. However, in many cases, you might want to say that I want the other VC to be exactly equally incentivized and equally in the. I don't want to unnecessarily rub it in and have high ownership.
Okay.
there's limited advantage I'm getting. Why would I not just do it 1+1 and do 1.1 plus 0.9 to just let him know that, dude, I'm slightly more.
We actually started with 1+1. So and we had a discussion last evening, the team within us, where we said that we want to be seen as the lead investor. So maybe we have to 50+1, like, right? So that's why we just increase it to 1.1. Otherwise, we started with 1 and 1. So I don't know.
Actually, Pratik, that's sort of a theoretical point that one be a lead investor. Am I right in saying that even and when both are putting equal amount, you're saying that one can still be a lead investor even if it's equal amount?
I give the first term sheet. The other part is open, and the other either we give a term sheet together, or I give a term sheet which has 1 million optional for the other party. If he does not put in, then I will put in 500K. Something of that sort can be structured in the term sheet, but or I'll put in $1 million more. That can be structured in the term sheet, or it can be done this way. But this is important. This is important again. So I have not seen deals where 1.1 and 0.9 happens. Sometimes it's 1+1. Sometimes it's 1.5 plus 0.5. Because in that case, that has happened because I want to have high ownership in the company. Please come in if you want to, but I'll have it. Else don't come. We can have that discussion, but why? There's no point taking a middle ground. Like just either go completely there or completely here. And then if the other party requests, कि ठीक है 1.4 कर लो, थोड़ा सा हमें दे दो, 12% तो हमें देने दो, we'll figure it out. But it's either best to have it exactly equal, or so.
Okay. May I just add one more point here? So ultimately, as a lead investor, you want to optimize for your ownership, provided the amount of money that you're putting in is comfortable to you, right? You're not stretching and breaking your limits. At the same time, there are some deals in which you need a good co-investor because you feel that there is funding risk down the line or some other issues, or other investor can help the company in a complementary way than what we can help. And then the consideration of 1+1, or then the consideration changes from target ownership to maximizing it over time.
Okay. So without knowing the other party, maybe you cannot even decide whether it's 1.1 or 1 or 1.5. So that's a fair.
I think I agree with that. In fact, the thought also comes is at this stage, would you like to, maybe you have a point of view that a certain investor might be a good co-investor. Do you want to sort of bring them to the table or discuss with the founders that, what do you think about these people?
Exactly.
I guess that also happens a lot, right?
Exactly. Preferred stock, fair, liquidation preference as understandable.
So on the liquidation preference, Pratik, I had a quick question. So initially we had put in like a 3% cumulative dividend per annual, which stacks up onto the 1x liquidation preference, non-participating. And at the exit, all accrued dividends also count in terms of liquidation preference. Just to be fair, we removed it, but in the initial term sheet that we discussed last evening, that was there. What are your thoughts on that?
So so I actually saw that in one of the answers that was sent. So you're right. So by the way, dividend amount is a requirement of the instrument CCPS.
Okay.
It is a requirement. A preferred stock has a dividend component, and you have to specify it.
Okay.
So in general, in our term sheets, in Nexus term sheets, we do 0.001, 0.001%. Effectively, we are saying no dividend.
Okay.
Now, I have seen term sheets where it's 10-12% dividend. I believe it's super taxing. So the India market scenario is that most of us will have very, very low dividend at all, if at all, because we don't want to make money off that. We want to make money off company growing, and not for 7, 8, 10% that will get extra, because that's just penalizing the company without any reason. Okay. So most people do. So most term sheets I have seen from India have almost zero dividend. Okay. Some investors and again, many of these are corporate investors or strategic investors. They put 20, 15%, 10%, 12% dividend, which is about board of director, we discussed about it. Yeah, in general, one comment though, in the last case study, someone said one founder board seat and one investor board seat. Yeah, typically in such early stages, investor should not control the board. Almost surely will not control the board. So almost surely it will be 2 founder or 3 founder and 1 investor. And after this as well, it will be 2 plus 2 or 3 plus 2. So it's okay for investors to not control the majority of the board seat. A lot of the veto rights or a lot of the rights that we talk about are not majority of the board. It's majority of the preference shares anyways. So it does not matter. You, as investors, you have all the rights to have adequate corporate governance on the company.
Okay.
Sorry, Pratik.
Can we go to the ESOP 15%? Go ahead.
Oh, sorry.
I wanted to come back to the one you mentioned that usually the board decisions are the voting rights go to the preferred shares owners. Is that what you mentioned?
Yeah. So a lot of veto rights are with investor majority. Investor majority. The other way to say this is it is with a majority of preference shareholders and not all shareholders. So even if as founders you control 70% of the equity, the 3 of us investors who own 10% equity each, 2 of us can decide a lot of things. Which is otherwise. So for example, if there's a veto on if there was a veto right on expenses or veto right on ESOP management, then the founders alone can do it, right? Because founders own more shares, the founders have the right to do it. But for a lot of these things, investor majority have control, so that the company is managed in the right way.
But at such an early stage where you literally have just 2 investors, so it's 50% of the seat is, how does that work then?
You still write investor majority. You write 60%, 65%, something like that. You still write investor majority, and in next rounds, because you don't want individual rights. The rights have, as more investors come, the investor majority just continues. So you want investor majority to always own that right and not a single investor. So of course, when I'm the only investor, investor majority is me. But as more investors come, investor majority is a better right to have, better control to have than saying that individual every investor has the veto right.
Isn't that seen as taking away control from the founders? If it's
So again, so it might be seen as that way, but as you will realize, a lot of it is just corporate governance. And founders, when you sit with them, you can explain it to them that this is not about managing the company. This is just ensuring. And in fact, the founder would want the investor to have this right, because that gives the external world that confidence that investor has managed the company, because it is our fiduciary responsibility to manage that company. So it is managed in a very collaborative manner. Investors have this right, founders don't. It might seem unfair. It is not in the long run. And at the end of the day, when the money is from the investor's account to the founder's account, founders have all the rights anyways. So the other because the money is in founder's account, where founder is the signatory. I'm not the signatory. So investors, it's okay for investors to have control, so that the corporate governance is taken care of.
Also, Pratik, one question. To be a devil's advocate here, I'm on the founder team, but I feel the liquidation preference of 1x non-participant is too sweet a deal for us, right? What do you comment on that, like specifically?
Yeah, whatever is standard, it's done. See, liquidation preference all these things come into place when the company is not doing well. At early stage, truth is, Pi and Nexus don't think about what happens when the company is not doing well.
Right.
It's not our job to think like that. It's okay for us if we are not particularly worried about those small bits and pieces there. We are to begin with, we are trying to build a large company here, and that is what we are focusing on. So I would prefer to not fight on this, while fight on other things that ensures that either I can ensure that the company is managed right, or I can ensure maximum upside. I would try and maximize my upside than protect my downside. And this is just protecting downside, right?
Right. This is like the worst case scenario. What will happen?
The worst case scenario. Well, maybe I make.
So we don't want to optimize for that. Exactly.
Yeah, it's not it's my fiduciary responsibility to optimize for that as well, because it's not my money. I've taken someone else's money, and I'll play responsibility. But this is not the most important thing in my life.
Okay. Cool.
Also on that front, I think if I would have if an early seed investor ask for a higher liquidation preference, either the next investor in the next rounds will get me to negotiate it downwards, or they'll add on top of that, they'll stack on top of it, which will hurt me. So either way, it's not in my benefit.
Exactly.
By the way, 1x non-participating does protect the downside in the case that if the amount is just equal to the amount investment amount, then the entire money will come to that investor.
Yeah. So just to add to Manish's point, so it is my fiduciary responsibility to take care of the money that I have been given, and that is why I am taking some leg pref. It's not that there's no leg pref, but this is not. I'll do whatever is standard here. I'll not want to unnecessarily spend too many cycles on this, because this is not the most important thing for me. The other things are more important for me, where it's more about maximizing the value I can get when the company is large.
Yeah.
ESOP, from what I understand, you had 3 founders, and if all the founders are complementary and all the skills are done, then typically people don't ask for 15% ESOP. 10% ESOP is good enough.
No.
Typically that's the case. But again, this is if the investor believes that this might need some skill later, the investor will have a discussion with you before signing the term sheet, and then have you on the same boat, that both of us understand that this needs to be done, and that is why let's create this ESOP pool so that it's beneficial. Otherwise, if the investor does not want that, then investor is just doing this for the sake of positioning that it's a 7 million pre, but it's not really 7 million pre, it's really 6 million pre or 5.5 million. It's just positioning, and he's just being too smart about it and too cute about it.
Actually, this is investors' term sheet, by the way. So
I know. That's what I'm saying. He's trying to be too cute.
Okay, cool.
That he's saying 7 million pre, but in reality, the term sheet is really a 6 million pre term sheet.
Right.
Because the dilution has happened much more for the founder, and this out of this 5%, if this extra 5% is not given to employees, then effectively it is redistributed back to everyone.
Right.
So investor will get something. So he's just being too cute about it, and positioning that.
I think the reality comes, as you said, Pratik, in the what are the strengths of the team already. Yeah. And for example, if they are early PMF and there's a certain level of skill which is required extra, and that could come expensive, then so I guess without knowing the team strength and all, it's hard. But 10 to 15 is what we felt is the range.
Typically 10 is typically 10. If it's 15, then please tell me that this is the skill that's needed. Typically it's 10.
Sure.
Got it. This round, right? Even 10 may not have been needed because you've already gone a round past. This is the second round, and 1 year only ago you had a round. So if that was, let's say, some ESOP allocation must have been done in that round, right? 5-10%.
Right.
So the way to go about doing this as an investor is to figure out with the entrepreneur how much is unused ESOP, what is the hiring plan till the next round possibly, and then come up with a number.
Yeah, right. And in fact, if that 10% would be reduced, maybe this point was not even needed, as Manish mentioned, because that 10% would be diluted to 7, 8, 9% now. And even if you were doing 10%, you were saying that I'll top up by 2-3% more. Here you're topping up by 7-8% more.
Yeah.
Got it.
There has to be a rational argument. Otherwise, in every round, if everyone is adding 7%, then everyone is getting diluted too much. So
Pratik, it would be great if you could spend 2 minutes on explaining that the pay-to-play cause.
So let's do that. This all makes sense. Everything else we have discussed. So let's open your term sheet, please.
Pratik, do you want to do this drag along on 3x comment before we go?
Oh, right. So, so again, this is at the end of the day, this is the last resort type scenario. If there is no exit in that scenario, the investor can enforce drag along right. Now, why, as an investor, if I had an option that there was someone available at a higher price, of course I would choose that. So you could write it. This just protects the founder mode at some level. But at the end of the day, this was anyways a discussion to be had between the investor majority. and not with one person. So adding this clarifies it, but I would not again fuss about it too much. As an investor, I would prefer to not have this point. This is an investor term sheet. You have added this. I would prefer to not even discuss this and have the drag along right. In general, the founder should have asked me, add at least this so that it's a real transaction and you're not throwing me under the bus just because you are not motivated about the space anymore.
Okay.
So in general, I've not.
Yeah, in general, the threshold is put in lieu of the time, right? So if 6 years are already passed, right, and you've not given me an exit, then I'll drag you to whatever price I can drag you to.
Yeah.
But let us say you got a good exit at 10x or some IRR basis calculation thresholds within those 6 years, then there is a case in point for the investors to also drag it. We term it as a slightly founder unfriendly, but that is how I've seen thresholds. Not as a after 6 year also there is a threshold.
Yeah.
And just before we skip on to the pay to play, have you ever been in a situation, Pratik, where the terms that you've offered to a founder, and this typically doesn't happen where a founder also presents his or her term sheet, but the term sheet that you've presented is beyond what was the other side's expectation, and then do you stick with that to maintain your sort of credibility in the market, or do you revise it downwards?
Yeah, I'm sure Pi has a standard term sheet on their website. We also have a standard term sheet. It is very fair.
Yeah. Okay.
So we will always give that, even if the founder does not want it, we will want it to be fair, so that it's easier for us to manage.
Yeah.
And again, what we are doing is we are setting the stone for the next rounds.
Yeah.
We want things to be simple. We want things to be founder friendly, because for the next round we are with the founder, and if we start messing around with the term sheet, then next round investors will mess around with it more. And it's a problem.
Okay.
It's very simple. For most things, the founder does not even need to discuss about it. A few things founder needs to learn why we are doing it, but almost surely, other than a few things like valuation and amount of money, etc., founder discusses. Other than that, I don't think founder discusses anything. ESOP, sometimes founders want to discuss, but other than that, founder almost surely never discusses anything.
Okay.
And I mean, this is maybe a cliche, but this is not a zero-sum game. The term sheet negotiation.
Yeah.
You're going to not.
Yeah.
I have to give. You don't have to give. Okay. There's another comment I had on the quarterly vesting and the vesting of this term sheet, right? So this is okay actually, but another way of looking at it is, since 1 year back there was another round. Yeah. So whatever equity has been vested, you could say that is now going to be re-vested. Yeah. And then you can put another 4-year curve from here on, right?
Okay.
It's completely acceptable to reset these curves like this.
Okay.
Yeah.
Go ahead, Pratik.
Awesome. So I think this is good. In the interest of time, Ekbar, Ayushi, why don't you bring up your term sheet, and or maybe I could bring up mine first, because it will take 2-3 minutes just to run through my version. If there's something additional to add, I'll check. And then let's go through your round. So we discussed about 1.5x to 2x is the right way to articulate it. Split, we talked about that it could be 1 to 2. Written on the side, it will be 1 to 2. Dilution wise also it's okay. 10% ESOP could be changed depending on the team. Board of director decide. Vesting, as Manish mentioned, I can have 1 year or no cliff, and 1 year vested or no vested, and 3 year or 4 year vesting. These are the it's all fair. It's just whatever you want to do here. There's nothing very right or very wrong about it, and everything else we talked about. Yeah. So sorry, everything else we discussed. Arushi, why don't you bring your term sheet up and let's go through it once.
I think Pratik, it will be good for you to also comment on the reserved matters in Arushi's term sheet.
Let's talk about that.
So I'll be honest with you, we added that just for point of discussion.
Understand.
These are not, the point was not to be aggressive, but rather to bring up a conversation.
Yeah, just to be clear though, Arushi, you are an entrepreneur, and you are saying that these are the rights you would have expected for the VC to ask for. So these are veto rights for the VC. and it's not for the entrepreneur. It's the veto right that a VC has asked for you. This you are expecting.
Yeah. We want it to be fair. We don't want the VC to come and say that we want veto rights on these things.
Okay. So let's go one by one. Pay to play. Interestingly, many people don't ask for it, but it is important. I have not. So So again, with early stage investors, typically it does not matter. But I'll give you a scenario where this comes into picture. So, and that is why, by the way, as VC firm, we want to have smaller portfolio and not invest in competing companies or companies operating in similar spaces. But it happens a lot if you have a very large portfolio without the fault of the VC firm. So if you have 300 companies, 250 companies in your portfolio, it might happen that one company pivots and reaches to a situation where it is directly competing with some other company, which is okay. You did not plan for it. The company pivoted. You have shares in both companies. The fund can have Chinese wall, and the company can still operate. However, the fund now says that I don't want to invest in this company anymore, because this is competing with that company, which I believe is better. And I don't want to fight with that founder, which is that larger company, because my reputation is built by that founder. So in that scenario, this company is screwed, because this company is saying that you are my largest shareholder and you say I don't want to put money in you. Why would someone else trust me? And you are clearly saying that founder is better than me. How can you do this to me? So again, I have not seen this in our case because our portfolio is really very small, but I've seen this happen in other funds without any fault of theirs. So in that case, pay to play is important, right? Pay to play is important that investors, either if they are not willing to put in more money or more pro rata or doing their pro rata at till this amount, etc., then they can be required to sell their shares and get out of the company. It is an extreme situation. I've seen it happen in a couple of cases that people have asked for it in later rounds. I don't want this situation to happen, because that investor is investor in everything, and eventually all of them will compete. And I don't want to be a situation that I'm dependent on that investor's whims and fancies. And it happens a lot also when there's a large investor who operates only in one space, two spaces. So of course he'll invest in many companies in that space. Then what happens? And then entrepreneurs, being aggressive, sometimes expand much more than anyone would expect, and then they come into other categories. So how do you so that I have never seen it in action in early stage term sheets, but at least from an intellectual discussion, we have to understand why this plays a role in some cases. Now on the veto rights, so as people talked about that. Board of director cannot be an individual veto right, has to be a board discussion anyways. Issue of further securities cannot be a veto right. See, again, you're just planning for extreme situations here, but if one important portfolio company of mine wants to acquire this company because they want to augment some skills, in that situation, I as an investor in this new company, in this smaller company, might not be incentivized to let that company raise follow-on capital. Because I might want the larger company to buy that company because of my relationship with the larger company founder, or the importance of the fund equation for that founder. Because only if that founder is successful and lets me make exit, I'll make money. So in that scenario, like for example, like Uber's investors would do whatever it takes to work with Uber and work with Travis. And they might not be supportive of their smaller companies if Travis wants to buy them. So in that situation, you do not want one investor to have all the rights, and that is why it's fair to give all these rights to investor majority, because then it will almost surely be fair. Distribution dividends again is a matter of board approval, so it will depend on the boards. In early stage companies, dividends anyways almost surely never happens. Purchase or sale of capital expenses of any capital expenses beyond a particular amount, depending on the size of the company, 5 lakh, 10 lakh, 15 lakh, 20 lakhs. has to be there with the board. Again, this is more a corporate governance thing. It's less about I don't trust investor not trusting the founder. It's just about having a fair way of dealing with things, so that the investor has control, and the founder can also say that investor had control. So that way, it's just easier for the company to manage. Approval of transactions, the conflict of interest. So related party transactions are always in the purview of board approval, or the majority preference shareholders approval. It should not be a situation. At least it should be verified and confirmed with the board and flagged it. And you have to flag it if you are doing a transaction where your father, mother, brother is making money because of the company. Because you don't want to be in a situation where a company is losing money while someone else in your family is making money, and that's just so it's good to have. In fact, it is expected that if your brother, sister, wife, girlfriend is coming on in the company as an employee as well, then also it is presented in the right way, because you don't want to be in a situation where money is flowing out of the company in a not so very well accounted manner. Joint ventures, of course, board approval is required. Entering any loan agreement, board approval should be required. Dissociation or acquisition of assets with a value greater than almost in the line of capital expenses should be applied. One thing you did not talk about here, which becomes very important, is starting a new business line or operational things. Now, in that situation, you do not want the investor to have a say on it, while some investors ask for it. And again, this becomes complicated when you are either a strategic investor or as a financial investor as well. As an entrepreneur, you worry that my incentives might be aligned with some other company. So in that situation as well, you do not want the investor to have the right ever on business line approval, business lines, and those things, because you don't want the investor to have those controls. Again, investor majority, most things are okay, because the world cannot be in a situation that all your investors are against you. But one investor might be incentivized. So it's just important to ensure that none of these rights are there with one investor as a veto right. Yeah. Anything else, Manish? Would you want to add?
I'm good on these. I think one of the things I've seen is on this purchase and sale of capital expense, right? So as Pratik said, you may want to put a threshold on it below which you don't want to come in. So the way as an investor you want to design these reserved matters is that in the normal course of business, they don't need to knock on your door. But if there are certain things happening outside the purview which could be misused in some ways, then you need this thing. So in the same light, there is another reserved matter that is typically there, which is on what kind of people you can hire without taking a board consent, right? So there is a restriction on a certain salary cap or a equity cap or something like that, where you will need a board approval to hire a senior person, etc. Arushi, you can stop sharing your screen, and then we can see if there are some more questions here now.
So Pratik, one of the questions I had was, so you mentioned that investors should not have the right to tell you which business line to get into or not, that sort of thing. But as an investor, can I at least mention that these are certain areas that you can't get into? It may not be, so instead of a blanket, yes or no, can I at least specify? Because if I'm investing in a company that has strong adjacencies in some other areas that I'm invested in, how do I protect them getting into that?
Yeah, it's just wrong. I would argue as an entrepreneur, I don't want you to block me for those things. I think the fair way to do this is keep it open-ended, because you believe that 99% of the case, it will not overlap. Again, it's easier to manage a smaller portfolio that way. If you have a larger portfolio and if your strategy is that, then the right way to do this is keep it open-ended and ensure that there are processes in your firm that there is strict Chinese wall.
Okay. No, the reason I asked the question is because it's so common to see startups attack adjacencies and pivot and get into each other's domains.
Yeah, but you cannot define what would be that adjacency to begin with. You'll never be able to, and you cannot stop both the founders. It's just, again, paperwork is not as important. It's more about the mutual understanding. So a simpler way that I have seen it work is that different board members should be there in both the companies. One board member should not be there in the two companies, and then there should be a Chinese wall in the firm that can be managed.
On the voting rights side, Pratik, just to ask an additional question on that last part that you mentioned, what's the way of safeguarding if that happens in a case? Okay, like what do you suggest? Like people, like the firm which has larger stakes in some other company, which is in the similar realm of things that this current startup is gonna do. Do they give up like preference shares and like convert them into a lower profile, less powerful shares, or just to be a stakeholder but not really have a say in what they will do? Or how does that work?
Yeah, again, it's not a very common scenario. And in most cases, what people do is because pay-to-play is not activated, what people do is people just like have two different board members manage the two companies, and eventually things are decided on their own based on company's profits.
Okay.
So typically, this does not come into pay-to-play does not come into picture directly, but it's good to understand why theoretically it might be important.
The reason I asked this also is because I'm not sure that you guys have read about this. In March itself this year, Sequoia actually gave up 20 million investment that they had made in a smaller startup called Phoenix because they had a larger interest in Stripe, obviously. And I wanted to understand why would someone give up 20 millions of shares that they already had, right? Probably for like one reason is to show that they are a better firm, that they can give up things to on the fairer thing side of things. But I wanted to understand like what other reason would there be?
Yeah, so well, a lot of times this is about firms positioning as a fair firm, as you said. The other argument could be, in many cases, like I've seen a good firm do this, that they said that they invested in a competing company, and then the founders fought here, how could you do this? Then they said, okay, we'll not invest in this company from this fund, but they invested in that company from some other fund. So they were in the clear, and they did not do any media or anything about it, but they still gave money and had shares. So it is messy. It is not clean, and a lot of it is more positioning than real thing. See, at the end of the day, I can guarantee that there are many companies that compete with Stripe. Stripe is such a large company.
Exactly.
That you have to compete. It is, it's unfortunate. There's limited way you would argue that a logistics company in India would not be overlapping with delivery, or a e-commerce company in India would not be overlapping with Flipkart or Snapdeal or so on. So it's difficult to define it exactly, but you have internally your conscience should be clear that I knew that there's no overlap, and I acted with my best conscience. Other than that, you cannot. When you have larger companies in your portfolio, everything competes, right? Stripe and Airbnb and like Sequoia US, of course, has so many large companies in the portfolio. Everything competes with each other. It's difficult to manage, especially when you are because large companies typically do multiple things anyways. They're not just focused on one thing. So again, it's probably more important that early stage or mid stage companies are not competing. It's perhaps important that if you know that company will come to this path, then you should not do it. Third, which you should take care of, is at least you can imagine how things are panning. So for example, we have not invested in many companies, in many education companies, because we believe that a lot of them eventually have to make money by teaching. Although to begin with, they are not saying they are teaching; they are saying we are selling some low frequency, some high frequency or low ticket size products. But eventually, we believe that they will go into teaching. That's the only way to make money. Although no one says it today, but we genuinely believe that. And because that is the case, we'll not invest in a lot of companies because we have an academy and we are bullish on the company and we are large shareholders in the company. So it happens sometimes that we'll not do those things because we believe in some hypothesis. But you just have to make sure your conscience is clear and you can draw the line wherever you think you are right. The other argument a lot of VCs give me that it's okay to invest in competing companies, and a lot of these VCs have large portfolio. So a lot of VCs give me the argument, okay to invest in competing firms. You are giving yourself a lot of credit for saying that information sharing could happen, or strategic insights could be shared, or you're not 100% incentivized. It's entrepreneurs don't think like that. Entrepreneurs are building the company. You are just helping them. And if that is the case, then why do you want to take that ownership of not investing in portfolio in competing companies? Invest in companies where you think you will give maximum returns to your LPs and manage the companies that way. There is no right or wrong answer. It's just about what you believe in and what is the culture of your firm and what is the philosophy of your firm that works.
Cool, thanks.
Pratik, on the similar lines, I think I agree with most of the things which you and Mani said, that this paperwork is just to sort of carve out a framework, but it's more about the personal relationship, the respect, and this is a starting point, right? Because one example you gave is that let's say 2 or 3 years into a startup, there are certain adjacencies and certain complementary strength that you want a smaller company to get acquired by a bigger portfolio company, right? Now that is something which has happened over a period of time. You can't think of it at the term sheet level. So at that point, investor will have a point of view that we believe that you joining hands with this bigger portfolio company will be a good thing for everyone. But maybe the early stage company or the smaller company doesn't see it that way. They want to do it on their own, or they have their very different point of view. Like, are there certain let's say boundary conditions or certain ways that founders can protect themselves, or you think it's mainly going down to discussion and see where it could go, and it could go either way, and both the parties should be able to figure it out?
Yeah, the one way I've seen founders do it is founders explicitly write in the term sheet that you will not invest in these 5 companies.
Okay.
Or you do not have the right to sell shares to these 5 companies. So these 5 companies are out of bounds for everyone.
But everything else which pops up later is up for discussion, and
in every round it can change. That exclusion list can change in every round.
Yeah.
So as those companies are coming up, before that discussion happens, you can preempt it by saying, I want this to be there in the term sheet.
Yeah. And I guess if at a point you suggest a portfolio company to join hands with somebody else, but they don't want to join, although you believe you'll get higher returns, how will you manage that situation?
We do. First of all, I have to support the entrepreneur, because entrepreneur trusted me when he was taking my money.
Exactly.
So I will never ever even try and force it.
Yeah.
So, however, if I genuinely believe in this, I'll have an honest discussion with the founder and understand his thought process. I'll try and give him rational arguments on the advantages and the risks associated.
Right.
But at the end of the day, it has to be founder's call. It's difficult for investors to push on that as much. In fact, I would argue it's actually okay for the founder to say, so it's not about whether the company is my company or not. Let's say some investor, the discussion we are having is the founder has an acquisition if the founder has an acquisition offer, I believe it should be taken, and the founder believes it should not be taken, then how is it decided? So Facebook had an acquisition offer at $1 billion valuation from Microsoft or Google, I think, and the way it's told that the way that board meeting happened, that Mark entered the room and said it's just a formality, but because it has come, I have to say this to you guys. We have got an acquisition offer at $1 billion. Of course, we are not taking it. There's no discussion. Of course, we are not taking it. So, yeah.
I think it's about having that relationship of discussing it openly, putting the pros and cons, and then.
And it's really about a lot of times we believe that during the term sheet negotiation, if I'm able to say some hard things and listen to some hard things, and the founder is able to do that, it's actually positive. That we have so much comfort that we are able to hash out the difficult things.
Yeah,
we are not transactional. We are truly able to respect each other's point of view and not being emotional about things. It's actually good that we are able to have these tough conversations, and it's actually a positive sign. So, and while signing the term sheet, I know I want to work with founders where there is true trust, that I know that there are no cards that are not on the table. We have both of us have our cards on the table. देख ले भाई, कर लेते हैं, साथ में बनाना है, साथ में बनाएंगे.
Right. Yeah, makes sense.
Pratik, quick question. What is the general trend and what are your personal thoughts on outsized voting rights with founders, which is quite common in the US? Like in India, is that something that you see, and what do you feel about them?
Yeah, it's more about the maturity of the market. As an investor, I would of course say कि नहीं होनी चाहिए, because corporate governance bullshit. But best companies get created by founders who have freedom and long-term focus. So maybe investors should not be meddling when the founder is building that company. And there is no simple answer. It makes, sometimes we say that we want to ride tigers, and because that's the only way to build large companies. We don't want to. If I am involved in building the company, then almost surely the company is not doing well, will not do well. It is about the founder building the company, and I have to trust the founder, and I'm willing to ride on the tiger, because that's when I make phenomenal returns. Best founders are like tigers. There are no two ways about it.
So, but in India, is it common?
Yeah, so again, it's about the maturity of the ecosystem. Typically in India, it's not the case. But hey, in India, VCs are also not as large yet or as successful yet. So no VC or no one has seen success in, neither founders nor entrepreneurs. So we'll evolve over time, and we will also probably go down that path. But that it takes 10, 15, 20 years. See, it starts, at least in public markets, as far as my memory goes, and Manish, correct me if I'm wrong, that this started when Facebook was going public, and he asked for Class A shares and Class B shares and so on. Facebook has done phenomenally well after that. Instagram acquisition could have been disapproved by the board, but Facebook has done phenomenally well after, with all the things, with all the acquisitions that they have done, etc. Now, because Facebook has been successful, people would want to do that, right? Give those out to the founders. If you find bad examples, then people will realize that maybe this should not be done. Maybe this is the problem. Maybe Theranos happened because of that. Otherwise, Theranos would not have happened. So when you find a lot of bad apples, people will go back. The power and responsibility come hand in hand. A good example I would give here. Is that in India, like the Flipkart acquisition, like a lot of stories came out. Of course, I was not part of. I'm not friends with anyone in that bracket. But whatever you see, you realize that it was not as simple. And it happens at large scale, right? Because everyone's incentives are misaligned. We are talking about money, life-changing money here, and of course, and a lot of ego and personal reputation also comes in line for everyone: investors, entrepreneurs, acquirer, everyone. So it is not an easy answer. But till now, India has been more conservative. The base is that there is higher corporate governance than there would be in US. But US has shown the other extreme example would be both Microsoft and Apple are doing very well despite non-founder CEOs. Even if those founders were there and Gates is there and moved out and Steve Jobs is no more, But even if these founders were there, would you not? If such examples are proven a lot more, then you would argue that, hey, maybe entrepreneurs should not have as many rights. Maybe because in a good asset, an exemplary CEO can actually do a great job and maybe do a job better than the founder. And then there will be people will go back and the ecosystem will go back and then change what the standard term is.
Okay, thanks.
Let's do a quick time check with 12:15. Last 1 or 2 questions we can handle, if there are any. Otherwise, there is a full session in the afternoon coming, which will again go deep dive into similar topics, but with a different lens. All right.
Awesome.
Just 1 sec. I hope you guys can see my screen once I share it. Can you see my screen?
Yes.
Okay. So thanks, Pratik, for this fantastic session. I think somewhere we were all scared on how this negotiation session will go.
Yes.
And I think it has gone tremendously well. And
awesome. That's super fun.
Thanks for all your insights. And as part of this, right, what we are actually doing is a lot of speakers have come in from different funds to give their valuable time. And it is not just this time, also some time before this to prepare, etc. So in recognition of all this effort, we have been supporting KVN Foundation for the COVID relief. So thanks a lot for your.
Thank you, Manish. Thank you, everyone. Thank you for doing all the work and in solving the exercise and the exciting discussion.
Yeah.
Thanks, Pratik.
Thank you.